here's our 24 outlook. We'll briefly take a look at the S&P 500. Recently broke to new all-time highs. We're going to look at a liquidity waterfall. Small caps and mid caps are looking fairly attractive this year. Financial conditions are very loose, which is a positive, and there's really not that many signs of stress in some different areas of the market. So we've had a general movement in the positive direction over the last kind of 6 months. There are some risks. So we're going to look at four main risks to the market this year: inflation and interest rates, commercial real estate, which we touched on quite a bit last year. We've got a presidential election. That's going to be an interesting one. And then we're going to talk briefly about de-globalization. I think this is a bigger trend that we're going to be talking about over the next few years. But then look at our current positioning as well. So thanks again, everybody, for joining us. And let's go ahead and get started. So what we've titled this report is Walking the Tightrope. And the tightrope is this new all-time high list. So what we've got is this looks at the S&P 500 going back to kind of mid 21. So this was the all-time high, the peak in essentially the very first part of 2022, the first trading day of the year. We've gone 2 years and recently popped back above all-time highs. Bottom line, all-time highs are bullish. There's no other way to go around it. We had a lot of momentum coming into the start of this year. It had been focused on the bigger companies early part of last year. That's starting to broaden out. That's definitely a positive. And this tightrope, the theme, I think, for this year and possibly into 25 is, can the market hold these all-time high readings? It could bounce around here, but as long as we don't see a fast reversal lower, this should be a fairly positive sign. If nothing else, it's removed some of the very bearish possibilities from the immediate near term. So new highs are bullish, but this tightrope is what we're going to be watching to see if some of these risks are going to be able to knock it off or not. Liquidity waterfall. So this is kind of an interesting development that happened out of the bear market for 22 and into 23. So what this looks at is we're looking at the large cap, mid cap, small cap, and micro cap. And historically, when we look at a bear market like we had in 22, the markets were down over 30%. S&P was down about 35% peak to trough. What we typically see exiting a bigger bear market is your more aggressive areas of the market tend to outperform first. So we have this sort of stack ranked on this chart from best performer to worst performer. S&P 500 large caps at the top, mid cap, small cap, micro cap. This should be flipped. Most major bear market bottoms, you lead with the micro caps and small caps. So it's a little bit different than what we would normally expect coming out of a big bear market. But the opportunity is that this cascading waterfall of liquidity that moved into the big 7 stocks this time last year first, that liquidity then broadened out to the more broadly the S&P 500. It then kind of went down the size spectrum into mid caps, and we've seen that mid cap outperformance. Small caps and micro caps have yet to play catch up. The PE ratios are much more attractive than the S&P 500. They do not have quite the exposure to tech, which explains some of this underperformance coming out of this bear market. And it also has increased exposure to financials. So the micro caps, small caps, mid caps, as you go up the size spectrum, you get a larger concentration in tech and a smaller concentration in banks. So when we had the bank failures right about mid-chart last year, we saw a lot of the performance being pretty similar. This is where it diverged. When the mid caps and the large caps had more tech exposure, and we started to see this divergence right here, at the same time we had the stress in the regional banks. So what happened last year is It's unusual coming out of a bear market, but it also could present some pretty unique opportunities in small caps and micro caps. And that's what we're looking at here. So the IWM is the Russell 2000, which is 2000 stocks that are essentially the most broad way to look at small caps in the U.S. A few things with this chart. This goes back to 2018. And if the S&P continues to do well, and if we can stay above that tightrope and above that high wire, we should see catch up in the small cap and mid cap areas. If the Russell 2000 were to go and make new highs, that's a 25% move higher from here. So we've got S&P above their all-time highs from a couple years ago. Small cap has to go 25% to catch back up. There's a potential source of alpha. So we've been increasing exposure to small cap in portfolios really for the last 3 or 4 months in anticipation of this. Another thing that we notice here is that the market saw these high points in 2018 and 2020 leading up to COVID. This was the COVID crash. It's always interesting when the market tends to find price support in an area of previous price resistance. So here we're seeing the market had all-time highs previously in small caps here. We busted through it coming out of COVID. And when we saw the bear market in 22, it consistently found lows at this previous all-time highs. That's also a pretty positive technical sign. So, it could still chop around. We can see over the last year and a half or so, this has been the definition of a choppy sideways market. If it can break out of this range, we're probably going to move fairly quickly to these all-time highs. So I would not be surprised to see some opportunity in small caps for the first part of this year. There's still a risk that it kind of flounders around in here. And if we see a deep recession, maybe we kind of come down here and break below this 160 area. But I would anticipate with the strength in large caps that does spill over and drag some of these other areas up. Why? What's happening that's causing this? Well, there's some pretty big data points that kind of point to it. One is overall financial conditions in the economy. This is also pretty surprising. So what we see here is as this level moves up and it's on the high end of the chart, that means that financial conditions are easy. That's good for markets. That's good for economic growth. When it's lower, things are tight. So lending is harder to find. The stock market's poor. Typically have inflation that's bad. Housing isn't under stress. Housing market's not that great. So all these different things contribute to the financial conditions index. We've seen this easing despite the Fed really aggressively raising rates starting about here. We've seen conditions ease, which has supported financial markets. And this looks positive right now. We're not seeing this start to roll over just yet. So there's what we saw in 21 was financial conditions stalled for over a year before we started to see that the tighter or the loose financial conditions not be supportive of markets. So this is just because it's very loose does not necessarily mean that that's a high point for the market. We tend to not see that high point be an event. So we should have a little bit of a tailwind here from financial conditions. That's a positive. Another positive, credit spreads. So what credit spreads look at is the bond market pricing in recession or default risk? This particular credit spread looks at junk bonds versus treasury bonds, both 10 years. So corporate junk bonds versus 10-year treasury yields. As this line goes up, that means that the yields are higher in the junk bonds than in the treasuries. That's a sign that the market is moving within the fixed income market to the areas of safety and away from the areas of risk. So as we see this line move higher, that is the market starting to price in credit risk. Obviously, there was a massive repricing in the COVID crash, which is this big spike. But what we can see is that the spreads consistently moved lower. That was a tailwind for markets. We had a nice pause. Every time this line has gone down, we've seen a supportive equity markets. It's been supportive for higher prices. We've seen the same thing here. We've seen these credit spreads start to tighten. That's a positive sign that the bond market is not real concerned at this point. We should start to see plenty of time before we would start to see market stress outside of a COVID type of situation. The credit spreads can widen before it really starts to affect the stock market. So given that we're almost at all-time low credit spreads, especially in a higher interest rate environment than we were a few years ago, the bond market is telling us that we don't have an immediate concern for lower prices. So another positive there. Little bit, maybe a little geekier way to look at this, defensive versus cyclicals. So one of the ways to judge what's happening within the market is to look at two areas of the market and compare those to each other. So we're going to look at three different ones. So one is staples versus discretionary. This is this dark blue line. And when this line is declining, the discretionary area of the market is outperforming staples. So that's a reflection of the consumer. The consumer is spending on things they don't necessarily need, but things that they want and that they like, as opposed to staples, which is butter and toilet paper and water and things like that. The consumer discretionary are iPhones and luxury goods and travel and things like that. So as we see this line decline, that's a relative outperformance of the more aggressive area of discretionary beating staples. So down on this line is good, just like down on the credit spread line is good. Same thing happens, this middle line, this blue, kind of sky blue line, bonds versus stocks. So as stocks outperform bonds, this line is going to fall. Been very consistent. Stocks have been a better place to be than bonds. That's a sign of risk taking in the market. Same with utilities versus tech. Tech being more aggressive, utilities being more conservative. As tech outperforms, this orange line will go down. So we've seen three very big areas of the market. They're just really not giving us any confusing signals whatsoever. It's been pretty consistent that these areas, the more aggressive areas are outperforming the more defensive areas, especially off the lows from last year. So there's some good things, obviously, that's happening, a lot different than our 23 outlook, which said we have a lot of risky data and that the potential for the market to go higher is probably a lower probability. The market had a good year last year. That's just happens sometimes in the market. It's not physics, with market moves and economic moves. It's not A squared plus B squared equals C squared. You have probability of scenarios. And last year, the probability was saying that we should expect a recession, that we should expect more risk. It simply didn't happen. A low probability good market happened. And we missed the first part of it, but we caught the last couple months of the year, ended up with pretty decent returns for the year. This year, we kind of have to watch for the reverse to happen. We've got this consistent kind of improvement in data, improvement in the underlying data within the market. The economy's okay, employment's okay, financial conditions are good. We have to kind of watch, is the high probability scenario kind of sideways or up? So is it going to be the reverse? We're going to have a lower probability scenario that might be worse. What's the potential for that happening? We think there's basically four things that would potentially cause that and cause the market to fall off of that tightrope. One is the expectation for interest rates. The market is projecting 1.25% interest rate cuts, so 5 quarter point rate cuts in 24. A couple of weeks ago, it was projecting 6. We think that could be a little too optimistic. The market is pricing this in right now. So the overall environment, the market is expecting, like I say, really the Fed funds rate to get just above 4. Given some inflation pressures, we think that you'd have to really see more of a deep recession to get those kind of cuts. We would not be surprised to see 2 or 3 interest rate cuts. 5 or 6 seem aggressive to us. That could be a risk to the markets. Second one, we've talked about this quite a bit, commercial real estate debt. There has been a continuing deterioration in that stress, and there has been distress continuing in commercial real estate. However, it has not gotten outside of really these workout groups. So as long as the banks are going to continue to work with these borrowers that are in default, commercial real estate risk can stay contained. Looking at the overall amount of loans in distress, what this chart shows is one, the pink line shows the total number of loans in default across all banks that are, excuse me, that are reporting. There's about 4,000 loans in default. And last year was almost 24 billion of loan value that basically went from performing to non-performing. Those seem like big numbers, but in the scope of the commercial real estate debt market, in the scope of the broader global debt market, it really is pretty small. The risk here is if some of these regional banks start to fail because of bank runs and some potential bad earnings from taking some hits on commercial real estate. There will be projects that default. There will be a lot of price risk and price drops in commercial real estate. The risk for the markets, as far as we're concerned, is as long as it doesn't cause bank failures, we should be okay. But let's keep our eye on it. This one, the geopolitics and the election. Spoiler alert, I know we're going to have a lot of conversations this year about it. We're going to talk about it. It's going to be in our face. It is pretty interesting that this election, I joke that it could be unprecedented in that we have a prison inmate versus a dead person. So that would be interesting, or at least versus a brain dead person and a prison inmate. So, we never know what we're going to get there. So there is maybe some heightened election risk, but we have to look historically at data. And frankly, the election does not skew markets one way or another as much as people might think. So this is a chart from US Bank. There's a lot of different things on here. But basically what they did is they said, okay, let's look at the 3 months following the election and compare that to any average 3-month period. And is there a statistically significant difference post-election versus any normal 3-month outcome? And essentially what it says is whoever wins, whether it's a Democrat or Republican, whoever wins Congress, whether it's Democrat or Republican, the market likes it more divided, but there's really not any statistical significant difference in the 3 months post-election than any other 3-month period. So it is, despite what TV news wants us to believe, it just doesn't have as much of an impact on markets as you would think. So we should expect, just because of the awareness of it and the potential craziness that could happen this year, it could be an outlier, but we really shouldn't expect that we're going to see a big market crash or big market rally just because one side or the other wins. Now, however, this is a bigger risk, in our opinion, over the longer term. One of the concerning developments is there was a chip bill that was passed about a year and a half ago that essentially the U.S. is trying to get their supply chain, especially with regards to computer chip technology and manufacturing, away from Chinese influence. And what that essentially means on a bigger picture standpoint is this trend of post-World War II increasing globalization is reversing. Throughout history, this is another thing that is cyclical. We think basically everything works in cycles. Globalization and protectionism also works in cycles. So this is from the World Economic Forum, and this goes back to basically the Civil War in the US. And we had this long period of globalization where the industrial age started to allow different countries to more easily produce goods that they're better at producing and sell those into countries that they're not as good at producing. And you had a nice economic activity. It's supportive of global economic activity. It's supportive of lower inflation. It's supportive of peace and reduced warfare by having economic ties between countries. Starting World War I in the 19 teens, we saw a 30-year period throughout that had a depression and two global wars that was kind of a result of protectionism. Post World War II, we had this massive boom in globalization. And frankly, the entire world benefited from it. We in the US benefited from lower price of goods, especially TVs and iPhones and things like that come from parts of the world that have lower labor costs, China and Asia and India particularly. So we benefited from that as an economy, but so did their economy. So as we get this potential transition, what looks like an obvious transition into a deglobalized economy, that has upward pressure on inflation, that has downward pressure on global GDP growth, and it could potentially affect the different sectors within the economy that could I think cause more dispersion. So when we look kind of longer term at what could the market be giving us over the next 5 or 10 years, this is one of those really big potential wet blankets that could be laying on top of the markets, that we could see this sideways move and not much growth because of this increase of a deglobalization. So something that is not necessarily a huge risk any given month or any given quarter, but it is a more consistent risk that we're going to have to incorporate because I do think it reduces overall GDP growth globally and overall earnings globally, which puts a lid on price appreciation. Okay. Switching gears there, only have a couple more slides. And then we can open up for some questions. Portfolio positioning. So this looks at our just standard balanced portfolio. This may or may not be reflective of your individual portfolio. Obviously, we've got clients in more aggressive, more conservative. So we want to just pick one down the road that sort of gives the visualization of last year. This goes back to the start of 21, so the peak of the market. We can consistently, this is looking at the allocation every day for the last 2+ years within the balanced portfolio that we manage. We had an increase of cash, a little increase of hedging. This gray along the top is cash in portfolios. Various shades of blue are US equities. Various shades of green are fixed income. Red is hedging. These sort of are brownish, goldish, yellowish are pipelines international. And what we saw is we were pretty much in a pretty defensive mode from May of 22, really all the way through. We got very defensive into the market lows, had an initial increase of equity. But then as we started to see the pullback in the third quarter, is really when our signals started to aggressively get repositioned back into maximum risk for your individual situation. Then we got that nice lift at the end of the year. So looking back at the S&P here, this is that dip in the third quarter that we really aggressively bought into. And so we were fully invested down here and got the benefit of this push to new highs. So That worked well. So we're fully invested as we speak, up a couple percent for the year. Um, for now, it looks like that's the proper positioning. We're obviously going to watch to see if some of these risks may knock the market off, but we could remain in a more fully invested posture, possibly for the foreseeable future, and that would be a very much a positive. Looking at where we're overweight, underweight, we're still pretty dramatically underweight two areas: duration in bonds. So we're continuing to be very short term in the bond exposure that we have. It just doesn't pay us to go out any duration just yet. I do think as the long end of the yield curve goes up, that's going to provide some nice opportunity for us to increase yield in the portfolio. But for now, we're remaining short duration. We're also remaining overweight US stocks relative to international, overweight US stocks relative to bonds, and overweight mid cap and small cap stocks relative to benchmark weights. So much more aggressively positioned than we have been in frankly quite some time. And just to relook at the scenarios, we talked about this a couple times last year. There's always three scenarios that could play out: kind of good, bad, ugly. The major bear, which is the ugly, that was a year ago, that was a much higher probability. Given the improvement in data within the market and the economic improvement and kind of globally the improvement, despite wars, despite the geopolitics, has been real improvement underneath the surface. That's moved the possibility of a major bear, in our opinion, to be a lower probability scenario. Now, again, like last year taught us, and many years, prior to that, just because something is a good probability doesn't mean it's going to happen, and just because something's a low probability doesn't mean it's not going to happen. But we do think that a major bear market it's kind of should be relatively rare at this point. We're not out of the woods yet. If one of these big risks happen, especially an increase, a dramatic increase in inflation, an increase of bank failures from commercial real estate, or a massive escalation in war tensions, we think that this major bear really is not that much of a concern right now as it exists right now. New bull market, on the other hand, that has increased in probability. We still don't think that we have the conditions present where we're just going to see a runaway bull market, kind of a 5 to 7 year bull market where we see a 300 or 400% total return. That's an increased in probability over the last few months. It's still not the likely scenario, in our opinion. We do think that it's still this sideways chop with maybe a little bit of a lean towards the positive side of things. So maybe we don't quite undercut and get all the way back to the lows of 22. But that could be a mild recession. We'd want to focus on yield in that environment. But when we look at kind of the sideways chop in a new bull market, that does say that it's supportive of price, and the stresses have really been reduced over the last few months. So really overall, kind of we're entering this year in a pretty positive data, positively positioned. We're going to see volatility that 5, 10, 15% moves happen all the time. So we don't think that the risk is going to be gone, but it does look like the big risk should be a lower probability, which is good. So 30 minutes, I think that could be a record for one of our webinars. So let's go ahead, and looks like we have a couple of questions here. So I am going to pull this up. So two questions. One, what were the signals that moved you back into the market? And do you buy Russell 2000 or S&P 600? Great question. We're going right into the weeds. I love it. So the signals were really twofold. In bigger picture, we have three signals that we look at. We have trend signals, we have reversal signals, and we have essentially a reversion to a mean signal. Our trend signals were giving us some of the exposure. So as we started to see the positive trend reverse from going down to up, we have data that is designed to pick that up. So some of the increased exposure was due to this trend reversing. Some of it we've increased what are called DeMark signals that give us, it's a little bit more of an exhaustion type of a signal. So if we see a downward move like this, for example, that we saw in the third quarter, we got some DeMark signals at the low point that allowed us to increase some exposure there. But it really was more position by position. There wasn't One of the interesting things about 22 and 23, especially 23, is there was never a massive, I'm going to go back over to this allocation over time. We never had like a signal where we got this massive inflow into stocks. There was a couple times where we had a 10 or 20% move, which can seem pretty big, but it was more just different areas of the market started to show improvement independently. And separately, we'd get some tech companies that like Amazon, Apple, Microsoft, Google, that clients all own. Those started to give us some buy signals in both the trend and the reversal signals. We started to get the small cap and mid cap trend signals. So it was a series of independent signals in different areas of the market that got us back to being fully invested. So good question there. And we have two small cap exposures right now: Russell 2000 via IWM, and a dimensional funds small cap that is more of a actively managed factor tilt to try to get us away from some of the financials and into some of the healthier stocks. So we've kind of combined a passive and an active with the index and a dimensional funds. So great question. Another question: how are we playing AI? We mentioned a few of those. We own Google, Microsoft, Amazon. We bought AMD in the fall. That was a nice reversal signal. I think we're up 60 or 70% on it. The AI stocks have just been pretty amazing. And that, I think that those are probably really good for the long run, but quite stretched over the near term. I do think that is one of the ways. I'm going to jump up here to this multi-asset chart that we had. I do think what we could see is small caps and micro caps outperform large caps because we've had such a strong run in these big AI companies. It's hard to keep that kind of momentum. I mean, they were up so much last year. It's hard to see them doing that again this year. So I could see the AI stocks and tech more broadly stall. They don't have to fall. They just, maybe they hover around these all-time highs and they're up 10% instead of 50%. And maybe the overall S&P is up, 5 to 12% for the year. Small caps and micro caps could be up 20 or 30. So, I think that the bulk of the AI move has probably happened, but the Microsofts, AMD, Nvidia is so stretched. But if we get a pullback, that'd be a nice one. You know, Google, those big tech companies, they're making so much money. And I saw where the revenue of the largest 7 companies in the S&P was almost $2 trillion. So the revenue of those top 7 companies are bigger than the GDP of many countries. So these companies are giant companies. They're cash cows. They probably should have a part in portfolios outside of major bear market, but that's how we've been playing it. So good question there. Some other questions. Any other questions here? We've got plenty of time. We've got um, look at your Q&A button. I don't think anybody's in the chat. Nope. Okay, well, if we don't have any more questions, I appreciate everybody joining us today for our 24 Outlook. We will be sending the recording out. We'll upload it to our YouTube channel tomorrow, and we will send out an email with a link to the video recording as well as these slides. And then we'll put everything out on social media as well. Don't ever hesitate to reach out directly to me with any questions. We'll put this on the website too, ironbridge360.com. Email me directly, jim.denholm@ironbridge360.com with any questions whatsoever. I tend to post the most on Twitter at denholm_Jim, but we kind of do that across social media as well. But thank you for joining us. Fortunately, like I say, we think could be a decent year with some risks that we'll watch, but we appreciate your time. We appreciate your business and relationship, and invest wisely.